Imagine checking your market alerts this morning only to find silver futures consolidating after yesterday's explosive surge, holding firm above $79 per ounce following an all-time high that has investors nationwide reevaluating their positions. This isn't a passing volatility spike, it's the direct result of a COMEX shortage that's intensified over recent weeks, positioning silver for potential moves well into triple digits by 2026. What if the everyday metal powering America's tech boom and energy transition is slipping away from exchange vaults, with implications that extend far beyond trading screens? To comprehend the scale of this development in the silver market, consider the foundational elements at play. Silver functions as both a monetary safeguard and a vital industrial input, essential for U.S. progress in solar energy, electric vehicles, and AI applications. Throughout 2025, worldwide demand has shattered expectations, with the Silver Institute estimating industrial usage exceeding 700 million ounces, largely fueled by America's renewable initiatives and technological expansions. At the heart lies New York's COMEX, where futures set benchmarks but physical settlements expose underlying tensions. Primary influences include domestic data center growth by firms like Amazon and Microsoft, alongside investor shifts amid currency concerns, drawing substantial volumes. This resonates with average Americans as silver supports national economic health. Disruptions could elevate expenses for gadgets and green projects, while its hedging function influences saving strategies during fiscal instability. The concerning aspect surfaces upon closer inspection. Yesterday's spot, close at $79.11, conceals a profound shortfall in tangible supply. Across U.S. outlets, restrictions persist on items like American Eagles, with markups hitting 20% to 30% above spot, and fulfillment backlogs reaching weeks for standard forms. This markup surge indicates a system where COMEX derivatives dwarf accessible ounces, fostering a facade of plenty amid eroding reserves. Conventional business reporting may label the recent highs as rally fervor, yet it downplays evidence of stock reduction and settlement issues suggesting entrenched vulnerabilities, keeping many U.S. participants unaware of accumulating hazards. Delve into the supporting metrics illustrating this COMEX-focused depletion through accessible figures. Per the Silver Institute, 2025 constitutes the fifth straight deficit year, with gaps projected at 95 to 120 million ounces, totaling over 820 million ounces since 2021, comparable to erasing more than an entire year's worldwide extraction. Domestically, AI sector needs drive U.S. uptake, with entities like Intel requiring silver for superior conductivity, elevating intake by 15% stateside. COMEX holdings narrate the strain. As of December 24th, aggregates rested at around 451 million ounces, down markedly from prior peaks, with deliverable registered portions teetering low post over 47 million ounces extracted early in December. Contrast with gold's steady stockpiles. Silver's gaps stand out due to its manufacturing draw. U.S. specific instances reinforce this. California solar arrays and Detroit EV facilities compete fiercely, akin to bottlenecks in semiconductors during past constraints. These indicators propel a distinct progression of triggers and outcomes heightening COMEX stress. Originating from Fed rate reductions across 2025, diminishing the dollar by more than 10% and steering capital to durable holdings like silver. Concurrently, U.S. measures such as the Infrastructure Act have amplified local solar and EV fabrication, boosting industrial extraction separate from financial influxes. With uptake climbing, COMEX shorts, focused among select institutions holding equivalents to hundreds of millions of ounces, encounter escalating rollover expenses, initiating covers that bolster futures. Effects compound. Diminished registered holdings inflate borrowing fees, fostering backwardation with prompt values surpassing deferred ones, denoting urgent rarity. This progression materialized vividly yesterday. Limited year-end participation intersected with persistent offers from U.S. producers reluctant to pause, culminating in the record close. Such interactions reflect persistent tendencies in silver's trajectory, where ongoing shortfalls ultimately dismantle barriers. Evoke the 1980 compression, as U.S. price pressures and material accumulation catapulted values from $6 to $50 rapidly, yielding over 700% returns grounded in parallel gaps and fiscal anxieties. More recently, 2011's climb during recovery-era easing tripled from $15 to almost $50, with Americans investing against currency erosion as manufacturing rebound constricted availability. COMEX featured prominently in each, with extraction demands unveiling derivative excesses. Present conditions parallel these, enhanced by U.S. tech and energy demands securing usage that past episodes lacked. As shortfalls compound across 5 years without notable mine growth, output stable at 800 million ounces owing to U.S. permitting obstacles and byproduct reliances, the rationale directs toward vigorous corrections, not incremental shifts. As stockpiles near sub-400 million ounce marks, the market approaches a threshold where material facts supersede contracts. Yesterday's thrust beyond $79 signifies the nullification of enduring barriers, with chartists observing drive that might probe $85 soon if extractions hasten. Should a prominent U.S. entity like a military supplier or photovoltaic leader disclose acquisition deficits, or if international frictions heighten provision perils from primary origins, the compression escalates, compelling widespread short resolutions in an ongoing cycle that's presently active. What awaits bears notable consequences for U.S. valuations, sectors, and governance. In favorable outlooks, heightened tiers invigorate American extraction renewals in locales like Nevada, contributing volumes across the forthcoming decade while promoting reclamation breakthroughs to alleviate prompt strains without impeding EV deployments. Authorities might broaden tactical accumulations under vital resources programs, fortifying distribution networks for sovereign security requisites. On the demanding front, extended shortfalls hazard, inflating outlays for U.S. devices and sustainables, possibly decelerating fiscal advancement or inciting commerce hurdles that modify international streams. For allocators, this setting accentuates silver's singular stance as a shield interwoven with American ingenuity, although fluctuations necessitate prudent evaluation. Yet as COMEX contends with this burden, one unavoidable fact arises. The systems that formerly restrained silver are splintering, urging Americans to address a rarity that's reformulating worth in manners the marketplace cannot further disregard. As trading continues today following yesterday's historic session, the COMEX shortage asserts its influence with unmistakable clarity. Spot silver has maintained its grip above $79 per ounce, building on the all-time high close of $79.11 set yesterday in a move that capped a year of extraordinary gains exceeding 169%. Reports from Trading Economics and Kitco detail the persistence, with the metal consolidating gains amid ongoing physical withdrawals that continue to strain deliverable stocks. This firmness links directly to the December vault pressures, where early month deliveries surpassed 47 million ounces, draining over 60% of registered inventories and to leaving combined holdings around 451 million ounces. As reported late last week, a level that leaves minimal margin for error against current demand flows. U.S. realities underscore this tightness as domestic dealers enforce ongoing limits on flagship products, with premiums steadfast in the 20 to 30% zone for physical delivery and backwardation entrenched as spot command's priority. Lease rates hold at elevated marks, diminishing short sustainability and encouraging prompt covers that sustain upward futures pressure. American ETF positions keep expanding, mirroring shifts toward the asset's dominant returns, while geopolitical elements, such as Venezuelan tanker enforcements, contribute defensive bids on top of the primary U.S. industrial driver, tech expansions and renewable deployments, consuming vast quantities without pause. The alignment with established COMEX episodes intensifies with sustained highs. The aggressive depletion patterns this month evoke the setup for 2011's forceful rise, where U.S. easing intersected with physical constraints to produce substantial multiples. The 1980 reference provides comparable severity, as domestic inflation cues met delivery limits for rapid revaluation. Modern enhancements bolster the comparison. Silver's critical mineral, standing amplifying national priority, alongside incentive-driven fabrication, increases that solidify demand in ways prior periods could not. With accumulated deficits topping 820 million ounces over 5 years, and extraction hampered by U.S. oversight delays and byproduct dependencies, the configuration supports resolute advances over tempered responses. Holding the $79.11 record and exhibiting resilient technical posture, the market engages thorough upward adjustment. Commentary from key sources anticipates $85 to $90 in the short horizon, reinforced by continued dollar softening and 2026 easing outlooks that preserve minimal opportunity costs. Overextended signals allow for periodic pauses and quiet volumes, yet the stock trajectory, nearing sub-450 million ounce combined benchmarks, secures downside through expectant physical restraint. Verification of further outflows and forthcoming updates or stepped-up sourcing from U.S. strategic channels could spark the subsequent vigorous phase, in line with outlooks toward $100 and beyond as scarcity factors integrate durably. The horizon carries extensive effects across U.S. pricing, industries, and directives. Favorably, amplified levels could activate latent domestic production in Nevada and similar areas, delivering incremental ounces through longer timelines while advancing reclamation methods to cushion immediate voids without hindering EV advancements. Critical mineral guidelines may hasten reserve growths, reinforcing channels for defense electronics and infrastructure durability. Adverse scenarios feature cost transmissions, elevating devices and initiatives, examining growth capacities. In allocation terms, silver's fusion of protective monetary features and U.S. industrial tie yields unique placement balanced by inherent fluctuation. As COMEX absorbs the ongoing extraction toll, the dominant forces confirm a fundamental pivot. Physical bounds are overtaking established derivative structures, requiring Americans to integrate a scarcity framework that surpasses short-term fluctuations, profoundly reshaping silver's valuation baseline amid heightening domestic imperatives. As today's trading session unfolds, the COMEX shortage continues to propel silver's trajectory with compelling force. Spot prices have consolidated around levels achieved in yesterday's historic close at $79.11 per ounce, the highest on record, following a surge that has delivered year-to-date gains surpassing 169%. Kitco and Trading Economics reports highlight this stability, noting the metal holding firm amid persistent physical offtake that keeps pressure on available stocks. This consolidation extends from the December delivery dynamics, where early month claims exceeded 47 million ounces, over 60% of registered inventories, leaving combined holdings near 451 million ounces as of late last week, creating an environment where incremental demand translates directly into sustained elevation. American dealers experience these constraints firsthand, with ongoing allocations on core items like Silver Eagles, premiums remaining in the 20-30% range for immediate physical, and backwardation signaling priority for spot over deferred delivery. Lease rates persist at high levels, constraining short positions and facilitating covers that underpin future strength. U.S. ETF accumulations show no slowdown as portfolios adjust to the metal's leading performance, while geopolitical developments, including Venezuelan tanker actions, layer additional monetary support atop the foundational U.S. industrial consumption from AI expansions and renewable projects. The correspondence with prior COMEX pressure points becomes increasingly pronounced as records stand. The sharp early December outflows replicate the environment leading into 2011's substantial advance, where U.S. monetary accommodation met tightening physicals for significant extensions. The 1980 comparison retains relevance, with domestic fiscal signals intersecting delivery bottlenecks for swift revaluations. Current elements amplify this. Silver's critical mineral designation heightening strategic focus, combined with policy-backed fabrication growth that entrenches demand beyond what earlier cycles offered. Cumulative deficits now exceeding 820 million ounces across 5 years, paired with supply limited by U.S. regulatory timelines and byproduct economics, build a case for pronounced upward adjustments. With the $79.11 benchmark secured and technical signals aligned for continuation, the market has entered definitive price discovery. Forward projections from major sources suggest $85 to $90 as reachable in the near term, sustained by dollar depreciation trends and 2026 easing forecasts that maintain low holding costs. Extended metrics may prompt brief pauses and reduced volumes, but the inventory direction, approaching sub-450 million ounce combined figures, offers robust support via anticipated physical bidding. Upcoming data confirming additional drains or increased sourcing from U.S. sectors could initiate the next decisive impulse, consistent with scenarios envisioning $100 and higher as scarcity premiums solidify. The consequences ahead influence U.S. economic sectors, policy directions, and portfolio constructions extensively. In constructive frameworks, elevated pricing activates dormant domestic mining in Nevada and comparable regions, yielding potential additions across extended horizons while fostering recycling enhancements to address short-term gaps without compromising EV initiatives. Critical mineral policies could expedite reserve developments, securing pathways for defense applications and infrastructure stability. Challenging trajectories include expense escalations permeating consumer electronics and projects, evaluating growth sustainability. For those structuring holdings, silver's blend of monetary defense and U.S. industrial integration provides distinctive exposure, navigated within the context of pronounced swings. As COMEX registers the accumulated effect of continuous withdrawals, the prevailing sequence affirms a lasting shift. Material availability is eclipsing long-established derivative influences, compelling Americans to engage with a scarcity outlook that extends beyond immediate milestones, fundamentally recalibrating silver's equilibrium in light of escalating national requirements. As the post-holiday trading session progresses today, the COMEX shortage manifests its dominance over silver's valuation with striking persistence. Spot prices have consolidated following yesterday's record-setting close at $79.11 per ounce, the undisputed all-time high, amid a rally that has propelled year-to-date returns beyond 169%. Sources like Trading Economics and Kitco emphasize this holding pattern, with the metal demonstrating resilience despite subdued volumes, as ongoing physical claims continue to erode available reserves. This steadiness builds upon the intense December activity, where deliveries early in the month exceeded 47 million ounces, draining more than 60% of registered stocks, and positioning combined inventories near 451 million ounces as last reported a precarious buffer that magnifies the impact of sustained industrial and investment flows. U.S. market participants confront these realities directly, with dealers nationwide upholding rationing on staple products, premiums entrenched around 20-30% for physical acquisition, and backwardation reinforcing the urgency for immediate metal over future commitments. Lease rates linger at prohibitive heights, undermining short positions and accelerating covers that bolster futures pricing. Domestic ETF holdings expand steadily, capturing reallocations toward the metal's exceptional track record, while geopolitical overlays involving Venezuelan tanker restrictions provide supplementary safe haven impetus atop the core U.S. demand from technological and renewable expansions. The congruence with documented COMEX strain scenarios sharpens as elevations endure. The pronounced early December withdrawals replicate the dynamics preceding 2011's vigorous escalation, where U.S. accommodation policies converged with physical tightness for outsized gains. The 1980 framework offers parallel intensity, as national inflationary pressures encountered delivery constraints for abrupt recalibrations. Contemporary attributes fortify the analogy. Silver's critical mineral categorization elevating domestic strategic weight, coupled with incentive-fueled fabrication surges that institutionalize demand in unprecedented fashion. With deficits aggregating over 820 million ounces through 5 years and primary output restrained by U.S. administrative processes and byproduct linkages, the foundation supports forceful upward trajectories. Securing the $79.11 pinnacle with robust technical underpinning, the market has committed to comprehensive discovery. Projections from prominent outlets envision $85 to $90 within reachable distance, underpinned by enduring dollar depreciation and anticipated 2026 policy adjustments, preserving negligible carrying expenses. Heightened metrics accommodate temporary respites in muted participation, yet the inventory progression, edging towards sub-450 million ounce consolidated markers, delivers solid underpinning via prospective physical engagement. Forthcoming disclosures, verifying intensified depletions or amplified procurement from American domains could precipitate the ensuing pronounced advancement, harmonizing with vistas extending to $100 and further as scarcity integrates enduringly. The prospective landscape profoundly affects U.S. pricing mechanisms, industrial networks, and strategic orientations. Optimally, amplified quotations galvanize quiescent domestic extraction in Nevada and allied locales, furnishing prospective increments across protracted periods while propelling reclamation innovations to temper proximate deficiencies without jeopardizing EV trajectories. Critical mineral protocols may propel reserve augmentations, consolidating conduits for defense electronics and infrastructural robustness. Constraining avenues encompass expenditure proliferations, infiltrating consumer apparatuses and undertakings, appraising developmental viability. Within portfolio architectures, silver's amalgamation of monetary safeguarding and U.S. industrial connectivity furnishes singular exposure, equilibrated against intrinsic oscillation. As COMEX accommodates the relentless accumulation of outflows, the operative sequence validates an enduring metamorphosis. Tangible confines are prevailing over protracted derivative paradigms, mandating Americans assimilate a scarcity orientation transcending episodic fluctuations, intrinsically reshaping silver's pricing equilibrium amidst surging indigenous imperatives.